Okay, we'll begin now. This is a different format than we are used to in the Nation Magazine discussion group, but a topic that I think you'll find very enlightening. We've had previous meetings on topics like the infrastructure for promoting the common good. And banking is one of those areas that most of us really don't know a lot about, especially public banking. We usually think of banks like the commercial banks, the ones that fund our corporate media. If you look at the Washington Post, you can see who funds the advertisements in the Washington Post will give you a sense of who funds the corporate media. Here we have an opportunity to ask how a public bank could do things differently and what opportunities it offers for financing things like the Green New Deal. And of course, this is a topic which we have heard some more progressive Congress people address recently, but they're doing it in a different way than the Green Party talked about the Green New Deal before. So there are lots of political issues that we need to think about when we're talking about institutional change. And our speakers today focus on public banking and specifically a national infrastructure bank. And you will learn about the history of this concept that has actually evolved, that has actually been used 4 times in our history, and what opportunities it would offer now. But I want you to think about things like Bernie Sanders talking about breaking up the big banks. Is that the same thing as creating a public bank? And what could a public bank do that even breaking up the banks that are too big to fail wouldn't do? So anyway, these are some of the policy issues that I hope we can focus on after an introduction to this concept of public banking and the National Infrastructure Bank. Our main presenter right now is Alphecca Muttardy, who is a macroeconomist who's worked for the IMF, the International Monetary Fund, for 25 years, and is now working with a working group of Our Revolution, one of the offshoots, something we can thank our president for.
Absolutely.
In thinking through what kind of America do we want to live in. And I will turn it over to her to present this material, and then we'll have an opportunity to discuss it and the policy implications for the kind of changes we should be thinking about advocating.
Thank you very much, Bob, and thank you very much for having me come here to talk to you today. This, as Bob said, this might be a little bit unusual for you because I know that you focus a lot on political aspects of our culture and our history. But what I'd like to do today is to talk a little bit about the economy and how the economy affects the politics, and then how the politics affect the economy. And is there anything that we can do with our current policies that are even doable today to get our economy back on track and to do something major about income inequality, which I think is at the root of everything. So I'm going to give you a little slideshow presentation here. I'll try and go through it as as speedily as I can. But if I say anything economic that you're not familiar with, please stick up your hand and ask me a question if it gets too wonky or anything like that. But I think that most of these aspects of this presentation you'll really be able to easily catch on to. So I'm also here with Stu Rosenblatt, who's a historian and an activist, and his wonderful wife Angela Vullo. The same thing. These two were responsible almost single-handedly for getting one of our pieces of legislation introduced, and now they're working on the other, and so they're just a phenomenal team. And we also have Srikar Godapati from our working group, who's responsible for this beautiful slideshow. So with that, I'll get started. What I'd like to do today is to talk about our economy over the long haul, over the long term, since 1900 actually, and then the short-term crisis that happened in 2008, and how this affects the average American's wage earning capacity, how it affects your pocketbook, and then talk about two pieces of legislation that we would like to get enacted. One is to reinstate a Glass-Steagall Act to prevent another financial crisis, and I'll explain to you what that is. And the other is to establish a fully funded national infrastructure bank, and I'll say a little bit about how this bank would be different from the central bank, the Federal Reserve, and also from commercial banks. And then what you can do to help, including contacting your congressman. This might be something that's quite workable. So let's start with what I think runs everything. There was a pundit that worked for Bill Clinton when Bill Clinton won the election over George H.W. Bush, and he became famous for the quote, "It's the economy, stupid," because there was a recession then. I'd like to paraphrase that a little bit. For those Democrats who wonder how Donald Trump ever could have won this election, for those Republicans who wonder how Donald Trump could have stolen their party, for those corporate Democrats and Republicans who wonder why do we now have a progressive movement on the rise, I would say it's the income inequality, stupid. It really does drive everything. The beginning of the last progressive movement around 1890 started with the same idea of a big disparity between incomes, and they went about resolving it with the same kind of policies that we would like to do today. So here's a graph of this is one measure of income inequality that starts at 1900 and then goes out today till 2017. And what you'll see is that the percentage of everybody's income that was taken home by the top 1% of earners went from about 20% in what's called the Gilded Age down to a low of 8%, or maybe 12% on this graph, in 1970. And this area was called the period of the Great Leveling. And we'll talk about a little bit what happened during that period. But since then, since 1970, look at this, the income equality by the same measure has gone right back up to 20%. And so we're right back where we were when the progressive movement was last sort of unleashed as a political movement. And I'd like you to pay a particular attention, or remember in your mind, one period on this graph. That was a period from here, which was almost 20%, down to 1957. This leveling right here really was essentially enabled or helped by the enactment of something called the Reconstruction Finance Corporation, which was our fourth iteration of an investment bank. So I just want you to keep that period right there in mind. So now let's look at one more thing. What is the effect of income inequality on everything? The International Monetary Fund did a really nice paper in 2011 where they said income inequality really does slow growth. If you can have better equality in the economy, then you would have faster growth, and this has a bigger impact even than the kind of government you have, the kind of trade regime you have, whether you have tariffs or whether trade openness or any other kind of factor. This is the biggest one right here, income inequalities. The way they did the measure was they looked at a whole bunch of different countries, what was their income inequality, and what were all these other factors that could explain it, what was their GDP growth, and then what were all these other factors that could explain it. And what they found is income inequality is one of the largest measures. Why does income inequality affect growth so much? And the main reason is because people don't have much to spend. They're very busy spending for the very basic essentials like housing and education, and they're not earning very much money, and they've also accumulated a lot of debt, so they don't have a lot of money left over. So there's no demand in the middle for them to buy goods, and that slows. Then there's not much for business, not much that businesses can sell over and above what these people earn at $15 an hour. It prompts the rich to invest less. Why? Because they have less that they can sell to these this lower 3/4 of the population. It increases financialization because now the rich have more money on their hands. They can't invest it in their corporations to sell products to everyone else, so they chase after yields by running up into the stock market or renting houses or pushing up asset prices because they can't earn money by selling goods in the real economy. And it weakens government because now they have much more money on their hands to pay lobbyists and to directly pay into campaign contributions, to do all kinds of things that Bob has been talking about. Everything from reducing environmental regulations to relaxing regulations on banks that are going to cause another financial crisis to even voter suppression, whatever it is. They're using their money in that way. And then it widens the pay gap between knowledge workers and the less skilled workers, and it prompts debt accumulation because these people are really strapped for money, so they're winding up becoming more and more indebted. The school tuition debt is escalated dramatically. I'll show you in a minute. And so has the purchase of consumer goods. Here is a measure of what the income inequality measure looks like over the same period. This is a measure called total factor productivity. It was a measure that was introduced by Robert Gordon in his book, What Attributes Over the Long Run Have Really Affected Growth. And one of them is how efficient the economy is. So if you have less people using electricity, if you have less less efficiencies or less innovations in your economy, then your economy struggles and works harder to produce goods, and your businesses do the same. But if you have more innovation and more infrastructure being built, then your economy is more efficient, and the output rises dramatically, as does the wages. So this measure, I want to point again to this is 10-year blocks. So this is the 1930s right here. This is the 1940s, after World War II started. This is the 1950s, after the war ended, and there was a different kind of production. But what you can see is this huge escalation in productivity. And these three lines are over a period of the enactment of the Reconstruction Finance Corporation too. So these infrastructure banks that we're going to talk about have a big impact on the economy. Now, what's happened to the economy since? Remember, the income inequality went down. Not only did the income inequality rise since 1970, but that made the federal finance, that strapped all kinds of finances of budgets, both at the federal level and at the state level. They're bringing in less tax receipts, so they have less money left over to invest in infrastructure, and as a result, they invest less and less in infrastructure. So now our productivity is way down. Actually, it's down to a really, if you look at the extension from 2014 onwards to 2017, we're down at up here we were at 3%, 3.5% per year of increase in productivity, and now we're down to about 0.3%. So the economy is much less efficient, and businesses are much less able to make a profit from doing production of real goods in the economy. So the contribution of the first thing I want to talk about is that's the long picture of our economy, becoming much more unequal in income. Tax receipts are going down, budgets are strapped over the long run, and our economy is much less productive. But then what happened in 26 or 28? We had a financial crisis. What were the approximate causes of the financial crisis? The approximate causes were I'm not quite sure what my first bullet means. Goodness gracious. Okay, we had income inequality. Persons were getting more and more into debt. We had a recession, a mild recession that was put on top of that, so that they were less able to pay their houses, and their houses went into default. That caused a whole cascade through the whole financial system, because the whole financial system was built on these derivatives that were based on mortgage-backed securities, which you might have heard of, and banks had borrowed from each other and become bigger and bigger and bigger with more and more derivatives. And so what happened was, when one of them failed, the interlinkages with all the other banks like that, they all went over like dominoes. So that at the height of the financial crisis, most people don't know, but 12 out of 13 of our largest banks were within 1 day of being closed. When a bank gets into a financial crisis, the bank regulators come in and they just lock up the whole thing and put the bank into liquidation. And they were within 1 day of having this happen, 12 of the large 12 of the 13. What was the cause of the buildup of all these derivatives and the melding of banks between regular commercial banks and something called an investment bank? What was the cause of all this? And it was the repeal 10 years earlier of the Glass-Steagall Act. The Glass-Steagall Act, for those of you who are not too familiar with it, was enacted in 1933 at the height of the Great Depression, when all of the commercial banks were closed. And what it did was it separated or broke up banks into two parts. One was the regular commercial bank that would take in deposits and lend out for home mortgages or for consumer loans or small business loans. And those banks, those commercial banks, would not own any type of derivatives or trusts or any of this other stuff that caused the financial system to crash in 1929. And they would be then also, their deposits would be FDIC insured. So that was the one set of banks. And then the other set of banks, the big investment houses, the ones that could broker big deals, or the ones that in any way speculated. What does speculation mean? That means that they buy something with the hope that the price of it will go up, like a big business, or stock, or a derivative today, but also with the possibility that the price might fall. And if the price falls, then that would cause that investment house to go bankrupt, but it wouldn't get any bailout from the U.S. government. So that was the separation that Glass-Steagall did. And when Glass-Steagall was rolled back, yeah, go ahead.
What did you call that bank?
That is an investment bank, yeah. So there's commercial banks that do the regular ordinary lending, and they're FDIC insured, so that if they go into trouble, that insurance would come and bail out that bank. And then there's these big investment houses that if they go bankrupt because they haven't been careful enough about watching their risk, then they would not get any bailout. What happened after it was repealed was these banks melded and grew bigger until that there was 5 really huge big ones today, starting with J.P. Morgan, Citigroup, Wells Fargo, the big problem banks today, and they own a whopping huge. They've gone back to the days when they're nearly ready to go over the brink again. So I want to talk about the immediate impact of what happened when we had a financial crisis. It was staggering. It was just almost, they call it the Great Recession because it was almost as bad as the Great Depression. The economy contracted by 5%. 81 million jobs were lost. 10 million families lost their homes to foreclosure. Net American worth of households fell by 22%. And this is interesting. The stock market, which is where most of the rich keep their money, that fell by 57%. So they were even bigger, the rich were even bigger losers from this financial crisis than the ordinary Americans were. And the Fed, the FDIC, and the Treasury spent $5 trillion more to keep the whole financial system afloat. It was a really devastating occurrence. But Wall Street had used its economic influence because it had a lot of money and caused this rollback of this legislation. Now, despite an improved economy, everybody on the news today says, oh, well, we're nearly at 4% inflation. Everything's back hunky-dory. Gee, Donald Trump should be taking credit for how great the economy is. But is it really great? Is it really great? Remember, we have this huge income inequality. It's still there. Over the period since the Great Recession, median wages have fallen in real terms by 10% from 2000 to 2018. 41 million Americans receive food stamps today. That's just ludicrous. That's everybody working for Walmart and even some adjunct professors. 11 million workers have dropped out of the workforce, some because of the baby boom, but a lot of them because jobs have shipped overseas to China or due to transformation of the economy through technology, but that's a lot of people dropping out of the workforce, and a lot of those that are of working age are on drugs. They're on Medicaid. They feel hopeless. They're living in rural areas. It's just a bad situation altogether. We need to be able to recapture all those people and bring them back in. Household debt has peaked at
What was the number of the people out of jobs?
11 million workers have dropped out of the workforce. So when they say that we're at full employment, we have only unemployment of 4%, they're not counting these workers that have dropped out of the workforce. They're only counting people that are actively looking for jobs. So it's a mismeasure.
I'm a little confused. You mentioned Wells Fargo. Wells Fargo is a bank that's located in my area, and people save there, and it's FDIC insured.
Right.
How is that one of the investment banks that wasn't insured, and that I don't understand.
Pre-Glass-Steagall, whatever was the precursor of Wells Fargo would have been a regular commercial bank that was not allowed to own derivatives or speculate. Right. And then post Wells Fargo, post a lot of these banks combined up. One bank was forced to buy another bank to keep it open, to keep some of the assets open. The bad assets were hived off, but they kept on going. They took this investment game, which is essentially, I asked Nomi Prince what is a derivative and how is it measured through the economy, and how is it different than a Ponzi scheme? Essentially, it's building blocks of stocks on stocks on stocks on stocks, so that each time you build a new block, that bank, that investment bank, gets to carve off a service fee. And that's how it's making its money. So it's building this pyramid of more and more and more trillions of derivatives up to the top. It's making its money solely on just building the blocks, essentially, not caring about the quality of the stuff that's inside the blocks.
But they're FDIC insured, or they're
They are. All those derivatives are on their books, plus your money.
Yeah.
In your bank, is on that book. So what happens if the bank fails? Not just one bank, but let's just say one bank fails. Is there enough FDIC money in the world to cover your deposits and everything else about the bank that's collapsing down if it's holding all these derivatives? And the answer is no. Yeah.
Well, they got bank charters after the $700 million bailout, and they didn't want to go back to Congress, so they went to their buddies in the Federal Reserve and got bank charters. They could get all they wanted from the Federal Reserve, which created $4.5 trillion worth of money.
Quantitative easing.
Bail them out.
Right. That's
so
part of
they didn't have to go back to Congress again because they almost didn't get it.
Right.
And the deciding vote on that was Nancy Pelosi. She was the person who could have stopped that, had she not agreed to that $700 million bailout.
Yep.
Million, you mean billion?
What year was that?
2008, 2009, something in that area.
Yeah.
And the Federal Reserve is private, isn't it? It is not a public.
It is. The Federal Reserve Board is a federal agency such that the head of the Federal Reserve Board has to be approved by Congress. But all the Federal Reserve banks are private entities that are owned by the commercial banks. They don't necessarily affect the decisions that like an owner's stocks would vote on procedures of a corporation. But Bob, in his email that he sent around to you, said he was maybe looking for a good book on the Federal Reserve. It's not really the focus of the discussion today, but we could go into a long harangue about the Federal Reserve. But it's really there is a good book on it, which I'll give to him so that he can send it around to you on the mistakes that the Federal Reserve has made, and they've been some really big whoppers. So our private bank would be completely independent of the Federal Reserve. So this improvement of the economy has not. 40% of Americans cannot pay basic food stamps, and then this is the most outrageous. The U.S. is now ranked 17th out of 19 industrial countries in terms of the Human Poverty Index. That means the percentage of people living below the median income, and the fact that we have really poor education returns. For the middle class, the squeeze has been terrible. They're for the middle quintile of wage earners, their real family income has gone down 8%. Meanwhile, all their costs are escalating, and look what's happened to the cost of higher education over that period. 2000 to 2012 is increased 62%. So we need a new deal to rescue our economy, just like FDR's Renew Deal. We need the same attribute, the same mechanisms here. Yeah.
You didn't mention savings and loans, which are somewhat different. Are they such a small percentage of our banking that...
Yeah, normally savings and loans never were meant to be big or an investment house or anything like that. They typically are the small ones that lend out for auto loans or so they have actually a different regulator, but they're essentially small. The problem is
what percentage of the banking?
Well, I think the assets of the large five, okay, start the other way around, that covers 90% of all banks. So the largest five banks, it's just, and they're all interconnected to each other with borrowings. So now they're really interconnected, and if one of them fails, they just all will go over like dominoes. Yeah.
Do you think they should have not bailed them out?
I think they knew, they had counted on the fact that they would be bailed out. Alan Greenspan said, gee, I can't imagine that the banks would have done anything like this that was not in their own self-interest to run themselves into the ground. But I think that the behavior now, today, of the Fed and of the banks and of the continuing rollback of regulations is that they are trying to skirt the rules again, and they are skirting the rules again, and they expect to be bailed. They expect to be bailed out again.
But if they are not bailed out, again, you think they should just be not bailed out. If they don't, if Glass-Steagall is not reinstituted, and there is another crash, would you recommend they not be bailed out?
What I would recommend is that that would absolutely be the time to break them up, and kick them out of the banking security blanket.
What happens in a bank when that happens on a smaller banks if your community bank goes bust?
Right.
FDIC sends some inspectors in on a Friday afternoon. They go see the president. They say, you're out of here. Mm-hmm. They take over the bank. They announce to the employees the bank will continue as normal, and then they go through the books.
Yeah.
And they write off all the garbage and make good on the they accept those losses, and then they...
But who do they pay first? They pay the...
And what happens, though, is that, see, these banks are owned by shareholders. The stock in those banks becomes worthless.
Right.
And that's why the bailout of the $700 million is so critical, because the super wealthy are the people that own the shares of those banks.
Yep.
And they would have taken a big hit had not been bailed out by Nancy.
That's very, very true, yeah. But what was the first radar that went off in the financial crisis when they were just about to be closed was they all shut down their lines of credit to small businesses. And the small businesses then couldn't even pay their payroll or their lumpiness through the month. And so they just fired everybody. And that was just exacerbated the whole thing, made it like a snowball going down the hill. So let's get back to our two solutions here. We need.
Follow quickly. It seemed to me that you could argue the bailout was reasonable, but the problem was that there was no penalty for the owners.
Well.
So you could have bailed out
the bailout was reasonable if you made the banks behave from then on. Right. But they have not behaved from then on, and they're skirting. Yeah.
They would have behaved. They would have been recapitalized. Like M&T Bank has come down from Buffalo and has taken over a lot of banks in this area.
Right.
The banks continue, except the people that own the shares of those stock were out.
They're counting on being bailed out again, and they're misbehaving again. There's a really good, if you want to read one really good website, it's called Wall Street on Parade, and it talks a lot about the banks that you don't hear about being serial fraudsters like Citigroup. It's a really good, it's called American System Now. Wall Street on Parade. So we need a new deal to rescue.
Wall Street on what?
Wall Street on Parade. It's a sort of a joke on the Wall Street Journal, which is not being a watchdog of banks these days. It's called Wall Street on Parade. We need a new deal to get our economy back on track. We need relief for the poor, to solve income inequality. We need recovery of economic growth, which has slowed from 2%. It was up at 10% during the World War II, but it fell down to 2%, and now it's just really chugging along at a really low number because of the income inequality. And we need serious financial reform. So we can go back to the two same drivers during the FDR days, which is to restore the Glass-Steagall Act and institute a national infrastructure bank. So what is Glass-Steagall? As I said, it was a bipartisan act in 1933 that separated these two sets of banks. During its 66
It says 93.
Thank you. We'll fix that one. 1933.
It should be 1930.
Yeah. And during its 66-year history, there was never a systemic collapse of all banks. There was a savings and loan, but the FDIC was able to, that was a small bit, but it was not systemic. Systemic is when they all close. Which could happen, honestly. So where are the banks now? Dodd-Frank has not worked well to pressure Wall Street to dismantle itself. There is an eye-watering $255 trillion sitting on the books of these 5 big banks that are FDIC insured. What is 255 trillion is hard to think about. That's 10 years worth of GDP production. If all those derivatives were to unwind at once, we would have to spend the next 10 years paying nothing except unwinding these derivatives with nobody else earning anything. Quantitative easing has reinflated asset bubbles. We now have new asset bubbles in stocks and housing and the dollar and bonds.
What is that again? Quantitative easing.
Quantitative easing is when the Fed, the quantitative easing is when the Fed pushes money into the banking system, which it did during the financial crisis, in the hopes that banks will then be able to shore themselves up and then re-lend out to stimulate the economy to get it growing again. The problem is it didn't get re-lent out into the real sector, all that money that was printed. It went into the financial sector, and they bid up stocks higher than they should be, and housing higher than it should be, and bonds higher than it should be, because they couldn't make investments into the real sector.
Quantitative easing is legalized counterfeiting.
It is.
Exactly what it is. It's legalized counterfeiting.
Yeah.
You and I could do the same thing.
Right. Well, actually, we don't want to poo-poo it too much because we want our national infrastructure bank to do the same thing. But any commercial bank, what happens, the way, for those, just really quickly, the way money is created is the Federal Reserve, as the central bank, prints a little bit of the money and pushes it into the commercial banks. That's to allow them to have their little cushion of fractional reserve banking so that they can lend out against their deposits. So it pushes a little bit of money in. And then the commercial banks take that money and all of their deposits, and they bring in new loans, and they print more money. So compared to what the Federal Reserve printed, the commercial banks actually print much, much more of it. But they have to have a demand for the loans. If they don't have a demand for the loans because people can't buy anything because they don't have any money, then they'll chase after these financial assets and cause a financial
When the
implosion.
reserve comes in, when the banks run into trouble, they take some of these loans they made and they pledge them as it's called the collateral for the additional cash that the Federal Reserve creates.
Yeah, we've had over our long history, we've had lots and lots of having to bail out banks. Really.
Generally, it's about a 10%. That banks were supposed to maintain a 10% reserve.
Yeah. Right. Actually, they've gone over that much more than that. So the fractional reserve limit is not so binding anymore.
But count on the large amount of student loans and the rather now higher than ever auto loan
Yes.
owed. So they're really fooling themselves or us or the regulators or somebody in saying that, yeah, we've got things covered.
The interesting thing is that the Federal Reserve itself did a research paper, where they said, what is the effect of inequality on all of this way that the Fed creates money and pushes it out, and is it stable? And what they came up with, the conclusion was that inequality by itself makes the system financially unstable because it puts this money into the hands of the rich because there's none at the bottom. And then the rich do this process of running it through the financial system and creating asset bubbles, and so that the whole thing is unstable. So that was even the Fed that said inequality is a bad thing for the finance sector. Yeah.
Is that available online?
Yep. If you want to sign up for my newsletter over there, my monthly newsletter, in my March newsletter that I'm going to send out at the end of this month, I have the link to that paper because I thought it was really a fascinating paper.
So when the Green New Deal says, well, we can always print more money to do more things, and people laugh at it, including a lot of...
Well, I think that the Green New Deal the Green New Deal, as far as we've done a little bit of an analysis of the Green New Deal, and it's as far as saying what the objectives of the whole thing are. And when I get to my description of our National Infrastructure Bank, I'm going to tell you that there's about that much overlap already between the National Infrastructure Bank and the Green New Deal. So about half of the Green New Deal would be paid. I don't think that they've thought through all the mechanisms for either how to fund infrastructure or how to fund the Green New Deal using a bank. Yeah.
When you said that the big banks were misbehaving, to me it sounds a little bit like why, first of all, why is there no control? Why is there no enforcement? And that can't be just a coincidence. And to me, it's
absolutely not
a systemic problem.
Because of the politics of the pressure of Wall Street. And this goes not only to the Republicans, but also back to Democrats. My biggest disappointment with Barack Obama is that he didn't put anybody in jail after that gave the message.
But then all those people would be out of work.
If he had thrown a few of them in jail, a few of the big ones in jail, they would have learned their lesson and behaved themselves. But now they've seen the lesson. Oh, if I misbehave, the government will just bail me out, and nobody will be called down. And if you look at the history on Wall Street, on Parade, on what's happened with Citigroup, how they've broken the law one time after another time after another time, and the regulators do nothing. They just turn. The prosecuting attorneys do nothing.
Well, it's a revolving door.
Yeah,
Holder now got a cushy job in one of the banks.
That's it. Yeah.
But isn't it also that the grip of the banks over the Federal Reserve? I mean, you literally cannot do anything about them. They have already established this.
All the laws are in place, but the Federal Reserve is turning a blind eye as well. Even this last week, their own rules, they're turning a blind eye to them being breached. Yeah. So what I would tell you is that all of these financial indicators right now in the system are flashing on red. Even my own institution, the IMF, has come out with warning signs that say if we go into another financial depression, another recession, it could cause a financial cascade, and we're much less prepared for this one than we would be for the last one. And believe me, my institution never says anything hyperbolic. For them to have said it every 6 months for the last year is really, the last year and a half is really quite astounding to me.
And there's the Brexit problem, right?
Yeah, and the fact that just last week the European Central Bank has decided to go back to quantitative easing. They say we're sliding into a recession, and this is Donald Trump's fault because of his tariff policies and everything else. So they're really quite angry.
Legalize counterfeiting.
Well, it's printing money. It's
Printing money, most people don't use actual physical money anymore. So
No.
Really mean.
Yeah, but I've done it. I used to do it at the IMF. I used to do it at the IMF because I worked in the Treasurer's Department. And it's just, you just go into an account and you open up a line, an accounting line, and you just fill it up with 20 million, 30 million, 40 million. It's like, you just put the money in, it's just an accounting thing.
Because you created claims against the economy and nothing to back up those claims.
Yes.
Nothing of value.
We want real stuff to back it up, and I'll show you how it can be done.
Would you like to share with us some of the reforms that are needed?
Yes. Where's Glass-Steagall now? I just wanted to tell you where it is. It has been introduced by these two wonderful people in the back here, trotting all over Congress. It is in the House. It's called House Resolution 790. It might get a new number a little bit later on. Sponsored by Marcy Kaptur and Walter Jones. Unfortunately, he just passed away. There's also a version in the Senate, and a House measure. This one is backed by Elizabeth Warren and was by John McCain, Cantwell, and King, so it's bipartisan also, and it has a feature in it for derivatives. This thing is stuck in a committee right now. It's stuck in the financial committees, and can't be brought out to the floor until they give permission to this. I asked somebody from the FDIC, the vice chair of the FDIC, what would it take to get Glass-Steagall reenacted? And he said it would probably take another financial crisis. That's really, really sad. But the bill is sitting there, and I think if any of you have congresspersons that you can call, they do respond. I mean, you call them up and say, are you signed on to Glass-Steagall? And would you like to do that? If enough of them sign on to it, we'll have quite a few co-sponsors in the House version. Maybe eventually they'll bring it out and start talking about it, and maybe Maxine Waters will start talking about how precarious the financial system is. So that's where you can help. You can call up your congressman.